I'm Cynthia Schaas. I'm a partner in the New York office of Sutherland, Asbill and Brennan in the insurance practice group, and with me is Justin Kitchens, an associate also in New York in the insurance group. And we're going to talk about the insurance investment laws. With the sustained low interest rate environment with which we've all been struggling in one way or another, it's not surprising that insurance companies that rely so heavily on investment income have been looking at less traditional types of investments as they've looked for ways to increase the yield on their investment portfolios. Given how highly regulated this industry is and how very complex the laws dealing with investments are in particular, this trend has led to more companies seeking our advice on how the regulators will view these investments. Accordingly, not only have Justin and I and others in our practice group been immersing ourselves ever more deeply in these laws and how to apply them, but we've also worked with our colleagues in other practice groups such as energy, timber, hospitality, derivatives. We've worked with them to better understand these laws as we find our practices increasingly intersecting. Justin, can you give us an overview of the investment laws? Just condense the many pages, different in the 50 states, into a few perfect, crystal clear sentences.
Sure. Thank you, Cynthia. The goal of the insurer investment laws is to aid regulators in assessing and monitoring the financial solvency of the insurance companies that they regulate so that those insurance companies can go on and meet their policyholders' claims. The investment laws do this by defining certain categories of permitted investments and placing certain quantitative and qualitative limitations on each of those categories. And while there's not a lot of uniformity among all the states in their insurance investment laws, there are certain common elements that arise from the NAIC accreditation process, whereby the NAIC mandates that each state adopts an insurer investment law that includes certain elements from one of two NAIC models.
Generally, the law that applies is that of an insurance company's domicile, its state of domicile, which might or might not be where its headquarters are. But New York applies many of its laws extraterritorially to insurers domiciled in states other than New York, but doing business in New York. And in the investments area in particular, other states sometimes find it useful to see how New York, which has a sophisticated capital markets bureau that has seen practically everything, views investments that seem to defy easy categorization. So the New York law is a good example for us to focus on a little more closely.
And just to give you some overview of the New York investment law, the New York investment law, like that of some but not all states, defines different types of insurers for the application of its investment laws. So, for example, life insurers are treated differently than property-casualty insurers, which are treated differently than financial guarantee insurers. And the limitations that are placed on the investment categories for each of these insurers are generally given in terms of that insurer's admitted assets. So, for example, life insurers, when they've met their minimum capital and surplus investments, are able to invest up to 20% of their admitted assets in the aggregate in equities, with a limitation of 2% for each single issuer of those equities. And whereas property casualty insurers don't have the same aggregate investment, they do have a 10% single issuer investment. So as you can see, the laws differ with the types of limitations, the amount of limitations, depending on the type of insurer.
We're talking about a lot of interrelated concepts here. Statutory, which is regulatory accounting, versus GAAP, or generally accepted accounting principles, and they're different. Permissibility generally, basket limits within what's permissible, valuations and ratings, including valuations by the Securities Valuation Office of the NAIC, risk charges applicable to assessing risk-based capital, which is exactly what it sounds like it is. And you know, these laws are also implicated when investment bankers and others in the capital market space come to us with products they're designing to sell to insurance companies, because different features might make such products more or less desirable depending on how they fit into this statutory framework and how these rules apply. So having analyzed these products from these different perspectives has really contributed to us here at Sutherland having the broad and deep experience and the market sense that we need to serve all of our clients in this complicated area.